Hello and welcome to this live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. We are almost halfway through 2022, and it seems this year is going to be very difficult. European economy struggling with the economic slowdown, China with COVID restrictions, Russia with Ukraine, and US with Fed tightening. It will be a tightrope walk for central bankers globally, taming inflation and at the same time not allowing growth to falter on another side. India's economic recovery has remained resilient so far, but global risks have certainly slowed down the momentum. What do economic indicators suggest? What impact will the government's recent measures have on the fiscal situation? How will the economy shape up in near future? To talk on all this and more, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Welcome, Mr. Basu.
Thank you, Geeta.
Mr. Basu, let's start with the recent announcement that government has made. It's the excise on petrol and diesel has been cut. Fertilizer subsidy has been high. Subsidy on LPG cylinder for low-income households has been introduced once again. Trade measures have been taken to cool off prices of steel, coal, and plastics. Do you see all these measures push up fiscal deficit beyond the budget estimates of 6.4% targeted for FY23?
The short answer is no. I don't see the fiscal deficit rising significantly as a result of these measures. Mm-hmm. These measures were made possible by the fact that the fiscal numbers for the last fiscal year were, the revenue numbers were exceeded quite significantly. Mm-hmm. In fact, the tax receipts from corporate income tax for FY22 are already 7% higher than the budgeted measure for FY23. Mm-hmm. And similarly, the FY22 actual receipts of personal income tax revenue are also about 4% higher than the FY23 budgeted estimate. So the two largest sources of direct taxes actually saw bigger collections in FY22 than have been projected for FY23. And if we assume that we'll have at least 10% growth in both those forms of direct taxation, then the budgeted estimate for the main sources of tax revenue will be exceeded by a lot in this current fiscal year. So that helps. This is a very fiscally prudent government. It wants to be fiscally prudent. And the reason for fiscal prudence is quite simple. If the government is profligate, if the government spends too much beyond its means, mm-hmm. then it crowds out private investment spending. And what that does is, that's one aspect. The other aspect is that it pushes up the total public debt. And if public debt rises, then the whole structure of interest rates goes up. You get a steepening of the yield curve for the wrong reasons. Mm-hmm. And a prudent fiscal policy of the sort that this government pursues mitigates against that possibility. It ensures that some sort of measures like the measures that they've announced in the last couple of days, those measures only are implemented when it is clear that the government's fiscal position allows it to go ahead with these sorts of measures. And I think we saw that even in the COVID year in FY21, that is, mm-hmm. only around September, October 2020, were the fiscal purse strings really loose, because in the first 6 months of the year, of that fiscal year, there were 2 months when there were almost no revenues because there was a complete lockdown. Mm-hmm. And so there was a complete shrinkage in revenues. So the government was quite cautious. It was still rolling out a lot of welfare that was reaching beneficiaries through the direct benefit transfer scheme. But India didn't go for a massive fiscal stimulus of the sort that the US did. The US had 14% of GDP fiscal stimulus that year, a huge fiscal deficit relative to its past. And the consequences of that are now being felt by the US. The US has unusually high inflation relative to its past. Mm-hmm. India does not. So part of the reason why India's inflation rate is relatively moderate compared to the rest of the world is that India was fiscally quite prudent in 2020, 2021, and now in calendar year 2022 as well. So they waited for clearer numbers on the fiscal front to come through before announcing this easing. Now, this is definitely going to help to lower the inflation rate, the headline inflation rate, and also the WPI inflation rate will come down. Now, WPI is not that important. India is one of the few countries in the world that paid so much attention to WPI inflation. And it did that because in the past, we had a very old CPI basket. The CPI, therefore, was not a credible measure of inflation, and so we had to use WPI. But that, for the last 10 years, that's no longer relevant. CPI is actually the relevant thing to focus on. And CPI inflation is high. I mean, it's gone up quite a lot, mainly because of oil prices. So they have now cut the oil price, which is a good thing. They have also increased the LPG subsidy. They have announced an effective hike in the fertilizer subsidy that was almost inevitable, and they have, unfortunately, I think this is very unfortunate, they have raised the export duty on steel to try and conserve steel. This, I think, is a retrograde step. I mean, India is not the only country doing it at this point. We had Indonesia banning exports of crude and refined palm oil. And for Indonesia to do that, Indonesia being the world's biggest exporter of palm oil, that had a very retrograde impact on the world as a whole. And India, as one of the biggest importers of palm oil, suffered grievously on that account. To some degree, you might say that India's export duty on steel is almost retaliatory to punish countries that are doing it to us in their own ways. Now, India is the second biggest producer of steel in the world, and it isn't the second biggest exporter, but it's the second biggest producer, with Russia and Ukraine being significant producers as well. Their absence means that globally, steel prices have gone up quite a lot, and Indian steel producers were benefiting from that. Right. Imposing an export duty, of course, means that you're eating into the profits on those exports, and 15% export duty is pretty substantial. It certainly will be hurting some of India's exporters, and most likely will ensure that domestic steel prices probably come down a little bit as a result. So these are inflation fighting measures, but I think that cutting excise duties on petrol and diesel is a clear positive all around. The hike in export duty on steel has some retrograde impacts on our own producers.
There was an article in Reuters this morning saying that India considering spending additional $26 billion to fight inflation. What can it be, sir?
Well, I don't think that you spend money to fight inflation. You rein things in. You try to rein in aggregate spending rather than boost it. Now, what India is seeking to do is to deal with the supply side. This inflation that we have right now is a supply side problem. It's a problem caused by a diminished supply of oil, particularly crude oil, which India is a huge importer of, that as well as palm oil. So it's a supply shock that India is dealing with. And one way to reduce the impact of the supply shock is to reduce our excise duties on petrol and diesel. Now, the long-term reason for keeping the excise duties on petrol and diesel is that India wants to induce a shift away from fossil fuels to renewables. And that is a long-term phenomenon that India is encouraging and is succeeding in doing, because a lot, the majority of new additions to our power ecosystem, energy ecosystem, are now coming from renewable energy. So the incremental change is moving in the right direction. But right now, the whole world has to deal with a fossil fuel problem. And we're not just us. Around the world, everybody has to deal with the fact that fossil fuel prices have now risen. And to the extent that we haven't yet fully succeeded, the world, of course, has not succeeded in moving away from fossil fuels. We still depend on fossil fuels more than on renewables, pretty much everywhere in the world. And so it is important, therefore, to take measures that are in India's national interest. It's interesting to notice that Germany, for instance, is taking measures in its own national interest. It is continuing to buy natural gas from Russia and paying for it in rubles, as the Russians have demanded. And not just Germany, most of Western Europe is doing the same.
Right.
So the European Union is basically doing that to basically protect its domestic consumers. Of course, Germany, the second largest party in the German ruling coalition, is the Green Party. The Green Party has been a big advocate of reducing fossil fuel dependence and moving towards greener renewable fuels. But now the current finance minister, even though he's a Green Party member, is obliged to allow quietly, without shouting from the rooftop, to allow imports of natural gas from Russia and to pay in the currency the Russians want. So now that's happening around the world. Countries act in their national interest, and India is doing the same. India is now reducing LPG and petrol prices by reducing the central excise duties, and to the extent that state VAT numbers are being reduced, that'll pass on even greater benefits to the consumer. Some states have done it, others have not. So there is an opportunity for several states to follow suit and thereby reduce prices for the consumer all the more. But I think the background is worth remembering that the excise duty is there for a good reason in the long term. And the long term logic remains that we need to move away from fossil fuels over the long term. But in the short term, we have to take measures that help our consumers bear the pain of extremely high inflation right now.
So what are your CPI inflation projections for FY23 now? And do you see RBI front-loading rate hike again in June policy?
I certainly see that there will be a rate hike, most likely in June. There will be more rate hikes. I currently expect only 75 basis points of further rate hikes from here. So I expect that by September, we'll be back to 5.15%, where the policy rate was, the repo rate was, in February 2020, before COVID hit us big time. So, so that I think is the likely scenario, that we'll get it back up to 5.15. Had there not been the measures that the government has just taken, had excise duties, etc., stayed high, and the pass-through of high global oil prices had continued for a couple of months, then we would have had to see much more than just 75 basis points. We probably have had to see interest rates go up by almost double that, perhaps as much as 150 basis points to contain inflation. But I think there are a couple of factors. First of all, I think that this reduction in excise duties, as well as the increased LPG subsidy, all of that will contain inflation a little bit going forward on its own.
Okay.
Globally, though, I think that beyond about July, August, we will begin to see a huge amount of new supply of shale oil coming in from the US. Shale is viable at any price above $60 a barrel. We've been, the global Brent crude price has been above $60 a barrel now for 15 and a half months. So it is it is only a matter of time. I think it's a matter of a couple of months before we see a big increase in the rig counts in the US and consequently in shale oil supply. As shale oil supply comes out, we'll see global Brent prices come down quite substantially. They would have come down even more had the Iran nuclear deal been revived. It hasn't been revived. It's very unlikely to be revived. And so that is a negative factor. That delays the recovery. I mean, that delays the supply enhancements in oil that we would otherwise have seen. But I think that by about September, October, we'll see Brent crude moderating quite significantly. And the second reason why it will is because the US and Europe are going to have to reverse their monetary easing quite aggressively over the next 3 or 4 months.
With the kind of measures that government is taking, Mr. Basu, do you see rising fiscal risk complicating the Reserve Bank of India's liquidity withdrawal strategy?
No, I think for the reasons I pointed out. First of all, it's worth noting that the disinvestment privatization agenda is continuing to move forward.
But that's not moving forward, sir. I mean, from last few years, we have not been.
No, but this year, now LIC was supposed to have been done in the last fiscal year. Yeah. It was delayed. But despite the delay, it has now happened in this fiscal year. So, and LIC, I think it's interesting to point out that although only 3.5% of its shares were listed in the stock market, it was done at a realistic price that the market would currently absorb. And I think that is a very, very smart policy. I have experiences from my career in the past. I mean, in 1993, Singapore Telecom was listed at an extremely high valuation. And as a result, for the next 10 years, Singtel's stock just kept going down, down, down. And it had a negative impact on the Singapore stock market for the next decade, 10 years. And in the end, I would say that the impact of listing this, the biggest listing that Singapore ever had, was really negative for Singapore's stock market. And overall, it has meant that Singapore has lost its ability to compete with Hong Kong as an alternative equity market in Asia. And in fact, now it's, trading volumes in Singapore equities are lower than in Thailand, etc. So that, it happened in 1993, almost 30 years ago, 29 years ago, October 1993. But the consequence of overpricing a privatization can be quite catastrophic for an equity market. So now the fact that LIC was done at a realistic valuation, at a valuation the market would be able to absorb, is actually, I think, going to be a big long-term positive for India and for not only for those who buy, those who bought into LIC now have bought it at a time when global liquidity conditions are adverse, equity markets are selling off around the world. There was very modest foreign appetite for LIC or for any stock for that matter. Foreign institutional investors are selling Indian stocks since October last year in large quantities. So despite that, LIC was listed. Those who hold it now, those who bought it at these valuations, if they hold on for, say, a 3, 4, 5 year period, they will be thanking their lucky stars that they bought in at these extremely attractive valuations. And in the long term, what that will mean is that other stocks too, other government companies too, can be listed at realistic valuations. Now, if you look at BPCL, good example of another very large potential transaction that is postponed for now because BPCL right now, given that oil prices are soaring, that might have been a good one to get done. But there's just one bidder left, and the government wants to ensure that there is a competitive bidding process before a transaction is completed. I mean, these are all, I think, good, solid reasons for postponing it. Since there's just one bidder left, it doesn't make sense to allow the privatization to go ahead until other strategic investors, bidders, can come into the fray and have a better sort of auction of another high quality asset. Now, the difference between BPCL and LIC is just a small, 3.5% of its shares are being listed. In the case of BPCL, it is going to be more than a majority stake being sold to a strategic investor.
Yeah.
Which means it's a potentially a very large transaction. Again, it could involve the buyer paying a very large quantity, and so it is best to wait. When there's a competitive process, if there are more than one, two or three buyers, then you can get better price discovery and complete the transaction. But I think that transactions will continue, and there have been smaller transactions along the way. Of course, Air India is not a trifling matter. It was done in January, and there's a small steel company in Odisha was also done in January. So we've had a few transactions done, and that process will continue. So now, with regard to your question on the fiscal, I think it's most important to understand that the revenue numbers are way ahead of targets for FY22. GST, the GST numbers, we've had a record GST revenue inflow in the month of April. Good numbers in the previous few months as well. So the final number for FY22 for GST will be way above. It's about about 10 or 12% higher than even the revised estimate for last year. It'll be slightly lower than the FY23 estimate. So in effect, the three main sources of government revenue are just booming at the moment, and that provides actually a lot more fiscal room than most of these market commentators are aware. Yeah, and because they're not looking carefully enough at the numbers. They just need to run better spreadsheets and see that there is no fiscal problem in India. The only question is, how much below 6% of GDP will the fiscal deficit be? My estimate is that the deficit this year, after everything else, will be in the current fiscal year 5.6% of GDP. And even that is, I think, a pretty conservative estimate. It'll be 5.6% or lower.
Talking about the food security, sir, the war has already exposed the interconnected nature and the fragility global food system is in. How do you expect to get over this food security crisis that we are facing? And India recently banned wheat exports. You spoke about palm oil export banned by Indonesia, which has now been taken back. So how do you expect this kind of a system being put in place so that the food security is taken care of?
Yeah, I think it's important to understand that India remains a major exporter of rice. We have, in the last few years, India was the world's largest exporter of rice. And there has been no ban, no interference in India's ability to continue to export rice. Rice is what India supplies to the world, what India exports and sells to the world. That is the significant food grain that India exports. Now, the problem in the world right now, though, is a wheat problem caused by the fact that Russia is the world's biggest wheat exporter and Ukraine is the fifth biggest wheat exporter. If you look at the top 10 wheat exporters last year, India wasn't among them. So India is not a significant wheat exporter, but at the height of the crisis caused by the absence of Russian and Ukrainian supply, India contributed its share, more than its share, by agreeing to some significant contracts for the export of wheat to some of the major importing countries, including Egypt, Indonesia. These are two important countries that import wheat. The Philippines. So these are countries that import wheat, and India was willing to go ahead and export to those countries. And most of those contracts that were done in March and April are unaffected by the recent imposition of a ban. What has been banned now is additional private sector wheat exports. I consider this, as an economist, as an advocate of freer markets, I think it's unfortunate for India to ban exports of anything, including wheat. But it's also important to understand why this has happened. The purpose of the farm sector reforms of September 2020 was to allow a freer market within the country, internal free market in food grains and other agricultural products, and also to allow free exports where necessary and free imports where necessary of these things. Now, unfortunately, there was a strong agitation against that farm sector reform bill, and in the end, it was repealed in November last year. So the repeal of the farm sector reforms means that the government is back as a significant player in both internal and external trade in food grain and other agricultural products. And given the fact that we don't have a fully open internal market for food grain, it is now necessary for the government to intervene at a time when world prices are very high, and there is the prospect of potentially a slight shortage. Well, not a shortage, but for the rabi crop in wheat may be 2 or 3 percentage points lower than would have been expected even a month ago. That will not have a hugely negative impact, but if it is, say, 5 to 10% lower, then that will have more of an impact. Now, the point is that India has very large stockpiles of food grain. The FCI godowns are very full, but some of that has been reduced through the exports in March and April. Plus, there's a big gap between the MSP, which is actually quite high in India at the moment. Normally, the MSP is above the world price of grain. The minimum support price in India is above the world price. But now the world price is quite a bit higher than the MSP. So there is farmers who wanted the MSP to become a permanent sort of law are now actually ignoring the MSP and trying to export. So it's a bit of an ironic situation. Perhaps the benefits of the old farm sector reforms have become very, very clear, have been clarified by these developments this year. But this year is unusual in that world prices of grain are up a bit, are up a lot more than normal. I think India is doing its part. I don't think India can be expected to do too much more and hurt its own food security. Now, as far as India's food security is concerned, there's no real concern. There's no real concern about food security in India. There's ample food grain. There's ample supply of most other things as well. One problem area, of course, is edible oils. Edible oils are clearly a problem area. India has never been self-sufficient in edible oils and remains a big importer. Now, edible oils, we can do without them. We have a slightly lower supply of edible oil. It'll be good for our health. But nonetheless, it is it is an essential aspect of Indian cooking, and it is an aspect that is dependent on imports from Indonesia and Malaysia, primarily, and also a little bit. I mean, alternative supplies can come from places like Ukraine, sunflower oil, and from Latin America and the US, soy oil. So now, unfortunately, this is a really bad year for edible oils globally. And edible oils are not going to kill us. They're not going to make us go hungry. But yes, edible oils will be a problem.
Coming on to China, People's Bank of China recently cut 5-year benchmark rates by 15 bips. What impact will the China's economic slowdown and property sector crisis have on the global and the Indian economy, sir?
Well, I think in many ways it is quite positive to see China finally slowing down, because if you look at China's monetary growth, China has had the most spectacular monetary growth that any country has had in history. And in particular, in the period from the year 2008, when there was a global financial crisis, between 2008 and today, China's broad money supply has gone from $6.5 trillion equivalent in August 2008 to 39.7 trillion in March 2022, this year. That is, by definition, it is the greatest monetary expansion in the history of the world. No other country has ever had a monetary expansion of this size. In fact, if you look at the entire stock of money in the United States, the world's largest economy, it is barely over $20 trillion. So the increase in China's broad money since 2008, the increase is greater than the total stock, current stock in the US. So that has resulted in massive overinvestment in China over this long period of time. I would say that China has overinvested in almost everything, but particularly in areas like steel, aluminum, cement, cars, semiconductors, chemicals. So I'd like to try and share a screen here, if I could. Let me try and share a screen where I show you. Can you see what I'm showing you on the screen?
Yes, I can.
Yeah. Okay. Yeah. This what I'm showing you on the screen, the table on the right shows China's share of world production of several things. So if you look at the table on the right, steel in the year 2021, that is last year, China produced 1033 million tons. 103, that is 1 billion tons, okay? 1033 million tons of steel. World production was 1950 million tons. So China was accounting for well over half of world steel production.
Right.
The second largest producer of steel in the world last year was India, producing 118 million tons. Now, this is an interesting figure for this simple reason that if you go back to the year 2000, so 22 years ago, in the year 2000, China produced 128 million tons of steel. That is, it was already producing more than India now produces.
Right.
India is the second biggest steel producer in the world now. India wasn't until 3 years ago. India, it was either Russia or Japan. India has just become the second largest producer. Now, in the year 2000, China produced 128 million tons. Before that year, no other country in history had ever produced more than 125 million tons. The US record was slightly less than 125 million tons. Japan reached 125 or 120 something in the year 2007. Now, no other country ever has produced more than 125 million tons. China went from 128 million in the year 2000 to 400 million tons of steel by the year 2007. In that year, the Prime Minister of China, Wen Jiabao, called China's economy unbalanced, unstable, uncoordinated, and unsustainable. And he said these four words, they're called the four uns, because he was very concerned about overcapacity. This was in the year 2007. Then in the year 2008, you had the global financial crisis. In 2007 and early 2008, China had been reining in credit and trying to stop this overinvestment splurge that was ongoing, had been going on for at least already the last 10 years or so. They tried to stop it. Unfortunately, in September 2008, there was the world financial crisis. And in the year 2009, China's total credit, it was called total social financing, the total amount of credit in the system increased in 1 year by 99%, nearly doubled in 1 year. It's almost unheard of for total credit in a country to double in 1 year. Mm-hmm. But in China, it did. And what did it do? That humongous increase in credit financed a new investment boom. And that investment boom resulted in steel production going from 400 million tons in the year 2007 to 1065 million tons in the year 2020. In the first COVID year, China's steel production increased while the rest of the world, in 2020, world steel production declined about 16%. China's steel production increased 3%. Interestingly, in 2021, China's steel production declined a bit.
Right.
This year to date, China's steel production is down about 6%. This year again, China's steel production is down 6%. Even before the COVID lockdowns began in China, steel production was coming down. Mm-hmm. Out of the top 10 steel producers in the world, the only one where steel production is going up is India. India's steel production this year is up. So, to my mind, there are a couple of positive aspects of this, but I'll come to that in a minute. Now, so I just talked about steel because steel is a good emblem of this problem. But the same thing applies if you look at aluminium. China, in 2020, China produced 37 million tons of aluminium. Mm-hmm. World production was 65.2 million tons. India was the second biggest producer, producing 3.6 million tons. So India is again the second biggest. In fact, India did 3.7 in 2021. So India and Russia were equal in 2020. In the year 2021, India overtook Russia and now is the second biggest. So aluminium, again, more than half of world production comes from China. Mm-hmm. Cement, still more than half of world production. But it's interesting that cement is a little different from the other two because cement is difficult to export. It's difficult to export by sea because cement can coagulate if it's taken by sea. So it has to be transshipped by road, and only small amounts can be transshipped can be sent by sea. And so actually, China's cement production peaked in the year 2015, and since then it's come down. But even though it's come down a lot, it is still more than half of world cement production. So what you see is basically China has overinvested. And I argue that while China was overinvesting, the rest of the world was seeing an investment drought. That investment drought occurred not just in China, but that investment drought occurred everywhere except in China. China, of course, had no investment drought. China had an investment boom. The rest of the world, India, United States, Europe, Indonesia, Korea, Taiwan, they all had an investment drought. Very sluggish growth in investment spending over this long period of time. And now that China today faces overcapacity in property, right. Massive overcapacity in property, and massive overcapacity in almost all its industries, particularly in steel, aluminium, cement. Mm. If China doesn't keep on pumping out more and more liquidity, it will face a really significant problem. Now, I would argue that despite the 15 basis point, 15 is a very small amount, 15 basis point rate reduction, China's ability to ease monetary policy is very limited now. Let me just, okay, yeah. Now, this, if you look at these two charts on China, the chart on the left shows China's foreign reserves, and the chart on the right shows China's export growth, import growth, and trade balance. Notice that China's trade surplus is at an all-time high. It is soaring to all-time highs. In the latest 12 months, ending April, actually, the April numbers are also out now. In the 12 months to April, China's trade surplus was $735 billion US. Humongous trade surplus. But if you look at the chart on the left, China's foreign reserves have been stagnant for the last 6 years. They peaked 8 years ago. They peaked in June 2014. In June 2014, they reached almost $4 trillion. In the latest 4 months, they've come down. The latest month, in the month of April, they had a decline of $68 billion in foreign reserves. So China's foreign reserves declined $68 billion. The trade surplus in the month of April was $51 billion. So in effect, they had net capital and services income outflows of $119 billion in 1 month. Now, this isn't by any means the biggest monthly capital outflow that China has had. Between August 2015 and February 2016, monthly outflows were over $150 billion, almost every month. So they are not quite there yet, not quite even at 120. But in the year to date, China has seen net capital and service income outflows of $344 billion in 4 months. So it is significant outflow. And this outflow is occurring because China has been trying to ease monetary policy. Last year, they cut banks' reserve requirements twice, in July and then again in December. In April, they cut them again. Last year, they cut them by larger amounts, 50 and 100 basis points. In April, they cut them very gingerly, 25 basis points, slight reduction. Similarly, as Geetu just pointed out, they cut the mortgage rate by 0.15%, just a little bit, trying to tentatively help a little bit to try and generate some demand, because property sales are down some 28% year on year in China. There's a huge decline in property sales, and property prices are very valuable because in China's system, the major source of revenue for local governments is land sales. Okay. Now, since they don't have other sources of revenue, they don't have a property tax rate, for instance. So when the central government met at the National People's Congress in March this year in China, they were hoping, economists were hoping that China would impose a national property tax. If you impose a property tax, then local governments have a source of revenue. But they didn't do it. So local governments are still dependent on selling land to generate revenue. But if you sell land at a time when there's no demand, the value of land will go down. The value of land goes down, existing owners of property will get nervous and they'll try to sell their property. If they do that, we'll get a further decline in property prices. So we could see a very sharp downward spiral. So China is in the horns of a serious property market dilemma. And this is an ongoing problem because China has huge overcapacity in property. They're trying to deal with it, but it's not going to be easy. Now, what this means to me is basically that fixed investment spending in China is going to slow down. We saw a little bit of that. Wait a minute, I showed you. Okay, if you look at this chart on the left of this one, then you'll notice that in the year 2020, there was a big slump and a big recovery in 2021. steady deceleration in the second half of 2021, a little, big spike in January and February this year, and deceleration again. So this is the story. Now, going forward, it's going to be very difficult for China to keep boosting fixed investment spending. If China doesn't keep adding to its overcapacity by continuing to overinvest, it presents an opportunity for the rest of the world to invest. So my argument for India's economy is that going forward, we're going to see a capex cycle pick up. A private capex cycle will pick up as we go forward, because Indian corporates are in much better shape. They've taken the last 5 or 6 years to improve their balance sheets. Remember, we had a twin balance sheet crisis. We had a crisis in banking system balance sheets and in corporate balance sheets. Everybody, there's too much debt. So India has been deleveraging for 8 years. Now that the banking system is cleaned up and continuing to be cleaned up, and we have the corporate sector deleveraged, there's enough of an opportunity for a recovery in domestic private investment spending. So I expect that in the first half of this year, we'll have we will basically have export-led growth for India. In the second half of the fiscal year, private capex will take the baton and run, and that'll help generate faster economic growth.
Mr. Basu, one question on equity markets. We have seen sharp fall in equity markets globally, and India is no different to it. From the highs, your Nifty and Sensex are down by 15-17% now. What sense do you make of the markets? There are fears of recession now. In next 1 or 2 years, we might see US and Europe slipping into recession. And then there are also concerns about the corporate earnings, getting hit by higher commodity prices. So what is your view on the markets in general?
Right. Okay. So my view is basically that in the near term, global equity markets will continue to adjust to a tightening of liquidity conditions, and particularly the tightening in the United States and Europe. Now, if you look at Europe, inflation is over 8% at a time when the ECB is still officially expanding its balance sheet, is still officially buying government bonds and expanding its balance sheet. So it makes no sense to be doing this, given that the ECB has an inflation target of 2%. It has a headline inflation, not a core inflation target, but a headline inflation target of 2%. They are way above that now. The policy interest rate is still negative, it's below zero in Europe. So Europe, the ECB unfortunately only meets once every 3 months. ECB Council meets once every 3 months. Its next meeting is about a fortnight away in June. And when it meets at its next policy council meeting, I think the ECB will be obliged to sharply reverse its monetary stance. It'll have to go from talking about tapering in October, that is continuing to expand between now and October, to actually immediately, possibly even raising interest rates as early as the June meeting, raising them and pushing the interest rate from negative to slightly positive territory. So that'll be an abrupt shift from an extremely expansionary monetary stance to a contractionary one. And that'll have a knee-jerk negative reaction on global markets. Plus, you have the US. Of course, now the markets are beginning to adjust to a change in US stance. The Fed continues to telegraph to the world that it'll be tightening monetary policy much more aggressively than it has let on until quite recently. If you remember, as late as October last year, the Fed was promising that they would not raise interest rates at all until 2024. Yes. Whole of 2022 and whole of 2023, interest rates were supposed to be near zero. Near zero. Just think about that. Now, it's likely that the policy rate in the US will be closer to 3% by the end of this year. That is a dramatic change. And that abrupt change in monetary stance is going to have a negative impact on the economy for sure. And it'll have somewhat negative impact on the equity markets. And that equity markets are now adjusting to that negative factor at work. Now, the yield curve, the US yield curve, had already inverted. I pointed out at my last Investonomics talk that the 10-year minus 2-year yield curve is an excellent predictor of recessions 18 to 24 months ahead. If that yield curve inverts, that is, if the 2-year yield is higher than the 10-year yield, you get an inversion of the curve because 2 years higher than 10 year, then a recession becomes inevitable within 24 months. Now, there's a lot of talk in the markets now that, this time is different. No. Well, I mean, it could be, but I don't think so. I mean, every single time it has happened since the Second World War, every time there's been an inversion of that curve, of that yield curve, within 18 to 24 months, you've had recession in the US. So, I think the recession could well be quite shallow because monetary policy by then would have probably done its job and would be thinking of easing off a little bit even. But the point is that this abrupt shift from almost permanently easy policy to a much tighter stance is going to result in inflation. So maybe I could I'll share my screen again and show you a few nice charts of this. So this is the US monetary policy era. So if you look at the chart on the right here, that's inflation. Of course, inflation is, both core PCE inflation and core CPI inflation. The chart on the right shows you that they are way above what they've been at any time in the last 40 years. The real reason for that is, if you look at, it goes forward too fast. Okay, let's see. So here, the chart on the left of this screen shows in black the M2 growth in the US over the last 110 years, going back to 1910. Actually, I could take you back 150 years. But the black line on the left is US broad money supply or M2 growth. And notice that the latest spike is higher than any time in the last 110 years. In fact, take you back 150 years, it has never risen as rapidly as this. So, of course, inflation has been worse in the past. Inflation this time is more subdued. But if you have such a long period of very high monetary growth, you naturally will see inflation. And that's essentially what's happened here. The red line is inflation on the chart on the left. It's finally picked up as a consequence of unprecedented rapidity of increase of broad money supply in the US. Now, the chart on the right shows you India versus US. So, on the chart on the right, the blue line is broad money supply growth in the US. The black line is broad money supply growth in India. So, if you look at the chart on the left, and if you look at the blue line, US broad money supply, M2, which is exactly the same thing as India's M3. M2 growth in the US averaged 6.8% in the 60 years before COVID. But during the COVID 24 months, from April 2020 to March 2022, average M2 growth in the US has been 19%. Way above 19% versus 6.8 average the last 60 years. Now it's 19%. In India, average M3 growth or broad money growth over the last 30 years was 15.4%. During the COVID 24-month period, it was only 11.1%. So India has not had extraordinary monetary accommodation. What India has had is a modest amount of monetary accommodation, but less monetary accommodation than the average of the last 30 years. So India's been relative, so this prudent monetary stance gives India more scope to do less in the midst of this global monetary tightening. India will do what is needed to get inflation back below 6%. So part of the story with that is that the excise duty on diesel and petrol has been cut. If you remember, in February, when I did my first Investonomics talk, I mentioned that there is scope to cut the excise duties. And I said that again, I think in every talk subsequently, that there is scope to do it. And there is scope to do it precisely because the fiscal revenue numbers, the tax revenue numbers are so strong. So given strength in other tax revenues, there is room to reduce excise duties and thereby mitigate the impact for make life a little easier for consumers. Now the point is, though this is possible and has been done, it's important to understand that over the long term, there is no getting away from the fact that we do need to reduce fossil fuel consumption in India and to keep shifting to renewables. And that process is ongoing. And that process globally will accelerate the longer oil prices stay high. If oil prices are high, then that gives alternatives, renewables, the scope to become viable at higher costs than they would have been viable in the past. So if they're competing with oil and oil prices are extremely high, that actually provides room for more investment in renewables as well. During that period, you get more investment in renewables. You're likely to see a boost to supply of renewables as well. So all of this will, I think, contribute to bringing Brent crude prices down, because not only does shale oil pick up, but renewables also become more viable. And the more renewables begin to take the baton globally, the worse is the long-term outlook for fossil fuels.
Very true, sir. One last question. Are you concerned about the falling rupee?
Well, I'm not particularly concerned about it because the rupee is not the only currency that is depreciating. The renminbi has depreciated a lot more in the past 6 weeks than the rupee has. So the Chinese renminbi has done worse. The Japanese yen has done particularly badly. And of course, it's pointless talking about our neighboring currencies, the Sri Lankan rupee, the Pakistan rupee. I mean, those have just collapsed. But the point is that we cannot live in isolation. If our neighborhood country, our neighborhood is China, Bangladesh, Sri Lanka, Pakistan. Japan is a distant neighbor, but it's not too far away. Now all these currencies are depreciating. We cannot have our head in the sand and start losing export competitiveness. India's exports have done spectacularly well over the last 16 months. India's merchandise exports have been the fastest growing in the world in 2021 and in the first 4 months of 2022. So this has been a spectacular period of merchandise export growth. We shouldn't shoot ourselves in the foot by keeping our currency too strong in the face of competitor currencies all depreciating. So we have to let the currency depreciate a bit against the US dollar. Against a basket, it hasn't depreciated that much. So, but of course, against the dollar, everybody is depreciating. We just need to allow our currency to depreciate as well. But actually, even if you look at the period from February till now, the rupee has depreciated not much more than the renminbi. Renminbi was stable for a while, and then most of the depreciation happened in April, a little bit in May. The yen, of course, people in Japan are very concerned about the yen's depreciation. I think it's great news for Japan that finally they're going to get some inflation as a result. Japan is the one place where inflation has been almost non-existent for 22 years. So it is actually for nearly 30 years, but really, especially the last, this century, in the 21st century, Japan almost forgot what inflation is. In fact, not only did they forget what inflation is, for about 10 to 12 years, no Japanese wage earner saw any increase in wage. They had forgotten that you can get something like an annual wage increase. What is that? For most Japanese, there's no such thing. There's no such thing. There's no wage increase. So but if you have deflation and your wages are stable, it's great. I mean, your real wage is going up. No, but of course that, since the Abenomics period began, Japan has had a little modest amount of inflation, but they've rarely got anywhere near the 2% inflation target. They're getting there now. It's great news for Japan. And if the yen depreciates in order to create that, all the better.
Thank you, Mr. Basu, for sharing your views on the macroeconomic scenario and the way forward. It was so interesting listening to you. Thank you so much.
Thanks, Geeta. Always a pleasure talking to you.